Shanghai, March 1934. Chen Wei enters the Bank of China on Nanjing Road. He's there to make his weekly deposit. Chen Wei is a textile merchant. He has 8,400 silver dollars. $6,000 are in this bank. 2,400 are in a wooden chest in his shop. 6 years of hard work. The vault room door is open. He glances inside while the clerk processes his deposit. The silver coin stacks that usually fill the right side of the vault now only fill 2 shelves. Chen Wei asks where the rest went. The clerk says they were transferred to the Hong Kong branch for rebalancing. The clerk's hands are shaking. Chen Wei notices. He nods, makes his deposit, and leaves. That night, he can't sleep. He opens his ledger. He calculates. 6,000 silver dollars converts to 1,890 Hong Kong pounds at current rates. He could transfer tomorrow. The Bank of China has served his family for 12 years. Converting feels disrespectful, like he doesn't trust them. He closes the ledger. He does nothing. 1 week later, his competitor, a textile merchant who shares his warehouse, converts everything to Hong Kong pounds. Chen Wei hears about it from the warehouse manager. He thinks his competitor is paranoid. 1 month later, newspapers report that Chinese silver is flowing to Hong Kong and San Francisco in unusual volumes. Government officials call it temporary speculation. Chen Wei's bank account still shows 6,000 silver dollars. The number hasn't changed. 3 months later, silver dealers on Sichuan Road are offering 23 cents premium over face value for anyone willing to sell coins. Chen Wei doesn't understand why anyone would accept paper for metal. The government hasn't issued any warning. By June, half the vaults on Nanjing Road are empty. By August, the textile merchant who converted in March has already repositioned twice. First to pounds, then to Shanghai real estate purchased with foreign exchange. Chen Wei still holds 8,400 silver dollars. He has done nothing wrong. The forensic record reveals something the official history still resists stating plainly. This wasn't one event. It wasn't a currency crisis that struck all at once. It was a cascade. 3 separate wealth transfers, each executed by a different group, each moving at a different speed, each activated by a different signal. Between February and August 1934, foreign banks in Shanghai began converting silver deposits to sterling and gold-backed currencies. They moved before the United States Silver Purchase Act even passed, before legislation became law. They were reading Senate committee testimony, watching price movements, recognizing what was about to happen in markets that Chinese law hadn't yet acknowledged. By September 1934, when those foreign banks had already repositioned, a second group began moving. Coastal merchants, textile traders, shipping agents, not because they understood monetary policy, because they watched the docks, because they noticed crates labeled commodity silver leaving Shanghai at volumes that didn't match official production statistics, because they asked questions, because they moved. The third group moved last, interior savers. People like Chen Wei holding deposits in licensed banks, trusting official statements, waiting for government guidance. They didn't move until October 1935, when the government finally abandoned silver and issued fiat currency. By then, 18 months had passed since the first signal appeared. By the end of this video, you'll know exactly what that signal was. What Wave 1 actors saw in February that Wave 3 actors didn't recognize until October. Why a 20-month information gap determined who preserved wealth and who funded the transfer. First, the mechanism that made the robbery possible. The mechanism begins with a simple fact about commodity money. It's 2 things at once. A Chinese silver dollar in 1934 was legal tender, face value 1 yuan, protected by law, backed by government. You could walk into any Shanghai bank and deposit it. You could use it to pay workers, settle debts, and buy property. That same silver dollar was also inventory. It contained 0.68 ounces of pure silver. Silver that could be melted. Silver that could be exported. Silver that traded on global commodity exchanges at prices set in New York and London, not by Chinese monetary authorities. As long as the coin's face value exceeded its metal value, it circulated as money. But in June 1934, the United States Congress passed the Silver Purchase Act. The law established a price floor. The United States Treasury would buy silver at $0.64 per ounce. Let's examine the arithmetic behind the arbitrage. A Chinese silver dollar contained 0.68 ounces of silver. Its face value was equivalent to 42 cents per ounce. The United States price floor was 64 cents per ounce. This created a spread of 22 cents per ounce. The profit margin was 52%. Every coin became an opportunity for arbitrage. The execution of this arbitrage required 4 distinct steps. Each of these steps was entirely legal under either Chinese or United States law. First, melt the coin. If you owned the coin, melting your personal property was not illegal. Second, export the metal. While Chinese law prohibited the export of currency, it did not prohibit the export of commodity silver. The customs form asked, currency or commodity? The answer was commodity. Third, sell the silver in New York. The buyer was the United States Treasury, which was actively seeking silver. The Treasury had not only announced its intent, but had also set the price. Fourth, convert the dollar proceeds to foreign exchange. This was a standard banking transaction, entirely legal in every relevant jurisdiction. These were 4 legal steps. There were no confiscation decrees, no soldiers, and no forced conversions. The currency liquidated itself. For Chen Wei, the silver dollars he had, 6,000 in the bank and 2,400 in a wooden chest, were simultaneously money he could spend and inventory he could sell. The mechanism did not require his direct participation. It only required his decision on which definition to act upon first. The pivotal question: who recognized this mechanism before June of 1934, when the law passed and the arbitrage window opened? The arbitrage window opened in June of 1934, when the Silver Purchase Act became law. However, the foreign banks in Shanghai didn't wait until June. They began to move in February. This was 4 months before the law passed. This occurred while the bill was still in Senate committee. It was happening while American newspapers were publishing testimony from Nevada mining senators about supporting domestic silver prices. The Hong Kong and Shanghai Banking Corporation started converting silver deposits to sterling. This wasn't all deposits, and it wasn't a single transaction that would appear in daily ledgers as a panic. It was a gradual process. An instruction was given to the Hong Kong branch: rebalance reserves. Shift 15% of silver holdings to sterling over the next 90 days. The Bank of China, Chen Wei's bank, the institution his family had used for 12 years, did the same. In March of 1934, the bank transferred silver reserves to its Hong Kong branch. The official explanation, the one the clerk would repeat to any depositor who asked, was consolidation for more efficient reserve management. Between February and May of 1934, Shanghai banks moved 47 million silver dollars out of China. This was not done through smuggling. It wasn't hidden in false compartments or disguised as industrial shipments. It was exported legally as commodity silver. The customs form asked only one question: currency or commodity? The banks checked commodity. The silver left Shanghai harbor in wooden crates marked for Hong Kong. From Hong Kong, it continued to New York. In New York, the United States Treasury bought it at the price floor the Senate bill had promised. The price floor that wouldn't become law until June, but that every foreign bank with a correspondent office in Washington already knew was coming. Chen Wei entered the Bank of China in March 1934. The vault door stood open. The silver coin stacks, which typically filled the right side of the vault, now occupied just 2 shelves. The clerk explained that the silver had been transferred to Hong Kong for rebalancing. That explanation was technically correct. The silver had indeed gone to Hong Kong, but what the clerk did not say was that it was being melted down. It was being reclassified from currency to commodity. It was being shipped to New York to capture a 52% arbitrage. This situation existed only because United States senators wanted to help Nevada miners, and because those senators had no idea that China's entire monetary system ran on the very metal they were trying to buy. Chen Wei made his deposit. The number in his savings book increased. Yet the silver backing that number was already crossing the Pacific. Between June 1934 and March 1935, 9 months passed without any official warning. Silver outflows began to appear in customs data. The shipping manifests were public record. Anyone visiting the docks could see the crates leaving. Shanghai newspapers printed statements assuring the public, silver reserves are adequate. Currency is stable. Export restrictions are under consideration. The government knew. The banks knew. Even the merchant community knew. Chen Wei, reading the newspaper in his textile shop in the Jiabei district, also read the same assurances. But what was actually happening during those 9 months, while the banks were moving in February and the newspapers said nothing had changed? The government chose capital controls. In August 1934, unauthorized silver export now carried a 10-year prison sentence. The decree appeared in official bulletins distributed to all Shanghai banks. The language was precise. It stated that export of silver coin or bullion without proper authorization constitutes economic sabotage. In October 1934, exit permits were required for any transaction over $500. Forms had to be filed in triplicate. Approval was required from the Ministry of Finance. Processing time was estimated at 6 to 8 weeks. The textile merchant who shared Chen Wei's warehouse submitted an application to convert $1,200. The form asked for the purpose of conversion, the destination country, and the intended use of the foreign exchange. In February 1935, banks received new instructions. They were required to report all foreign exchange conversions exceeding $1,000. This included the customer's name, the transaction amount, and the destination currency. The Bank of China installed a second ledger system specifically for tracking foreign exchange movements. But each restriction closed one channel, and it opened 3 others. Unable to export silver coins? Melt them first. Commodity silver export remained legal, as Shanghai's refining industry depended on it. The distinction was purely technical. Coins were currency, and metal was commodity. A crucible erased the differentiation. Unable to get an exit permit in 6 weeks? Shipped through Hong Kong. Hong Kong operated under British jurisdiction, with a different customs authority and different reporting requirements. Silver leaving Shanghai for Hong Kong required no exit permit. What happened after it reached Hong Kong was outside Chinese jurisdiction. Unable to convert large amounts at your bank without triggering reports? Find the merchant who imports textiles from Manchester. He receives payment in sterling. He needs yuan to pay his Shanghai suppliers. You have yuan. He has sterling. No bank is involved. No forms are filed. There is no ledger entry showing foreign exchange conversion. The mechanism adapted faster than the regulations. By March 1935, 180 million silver dollars had left China. Not through smuggling, but through workarounds that remained technically legal. Each capital control had been designed to prevent the previous month's exit strategy, and yet none could prevent the next month's. The question Chen Wei should have asked in March 1934 was not whether the government would act. They were already acting. The real question was whether government action could close an arbitrage that required only a crucible, a ship, and a merchant who needed yuan. The merchant who shared Chen Wei's warehouse was not a banker. He imported cotton textiles from Manchester mills. He kept his records in a leather-bound ledger, with columns for inventory, payments, and shipping dates. Every Thursday, he walked the same route, from his warehouse to the Shanghai docks, to verify his shipments had cleared customs. September 1934. Something catches his eye. 3 crates labeled commodity silver leaving for Hong Kong. The following Thursday, 4 crates. The Thursday after that, 3 more. Every week. The same labels, the same destination sequence. Shanghai to Hong Kong, then Hong Kong to New York. He asks his shipping agent a simple question. How much silver does China mine? The agent replies, we don't produce much anymore. Most of these shipments are recycled material. Recycled from what? The agent looks at him. Melted coins. The merchant did not understand monetary policy. He did not read Senate committee reports, and he didn't track United States commodity legislation. He understood one thing. What moves through a port is real. What leaves the country is gone. November 1934. He walks into the Bank of China on Nanjing Road. He requests the conversion of 12,000 silver dollars to Hong Kong pounds. The clerk processes the transaction. No complications. No questions about the purpose or destination. The exchange rate is standard. The merchant receives a certified draft payable at the Hong Kong and Shanghai Banking Corporation. He mentions this to Chen Wei the following week while inspecting a shipment of raw cotton. $12,000 converted, safer in sterling than silver. Chen Wei considers it. The silver dollar is legal tender. It's government issued, backed by commodity value. Converting it to foreign currency, melting your own country's money, feels wrong. Not illegal, just wrong. Almost treasonous. He does nothing. By March 1935, 180 million silver dollars have left China. The merchant didn't need to understand the Silver Purchase Act. He needed to count crates on a loading dock and ask one question about where recycled silver comes from. Chen Wei kept his money in the system. The merchant didn't understand the system. He just watched what it was actually doing. By March 1935, 180 million silver dollars have left China through legal commodity export channels. The Chinese government has announced capital controls with criminal penalties for unauthorized silver export. There are now banking restrictions and exit permits are required. None of it matters. What the government cannot stop isn't the smuggling, it's the structure. The wealth transfer doesn't require conspiracy. It requires three different groups seeing the same mechanism at three different speeds. Wave 1 moves on policy signals. These are things like Senate bill language, committee testimony, and legislative hearings that precede actual law. These actors reposition themselves before the Silver Purchase Act passes. They convert silver to foreign exchange between February and May 1934, which is 4 months before the price floor becomes official. They capture the full arbitrage, a 52% appreciation when New York silver prices rise above Chinese dollar face value. Wave 2 moves on physical evidence. This includes things like shipping manifests, empty vault shelves, and crates labeled commodity silver leaving Shanghai every Thursday. These actors don't read Senate reports. They count what moves through ports. They convert after the law passes, but before official currency reform. This period was from September 1934 through March 1935. They capture partial arbitrage, enough to preserve wealth, but not enough to profit significantly. Wave 3 moves on official announcements. This includes government press releases, newspaper statements about currency stability, and ministry guidance about reserves. These actors wait for institutional confirmation that a crisis exists. They convert between April and October 1935, after silver has already left the country. They receive paper yuan at government-mandated exchange rates for coins that no longer function as monetary reserves. Same city, same silver dollars, same information environment. The difference is not access. It's interpretation speed. Wave 1 sees a Senate committee transcript and understands that it means Chinese silver will appreciate in New York markets. Wave 2 sees crates leaving docks and understands that someone is melting legal currency. Wave 3 sees a government announcement and understands that the crisis has been officially acknowledged. By the time Wave 3 acts, the arbitrage window has closed. The transfer isn't currency confiscation, it's a reallocation from slow interpreters to fast ones. From people who waited for guidance to people who watched what actually moved. 237 million silver dollars. That's 70% of China's monetary reserves, all gone through legal commodity channels between June 1934 and October 1935. Not stolen, converted, by holders who recognized what their money had become, inventory with a better price elsewhere. The question isn't whether this pattern is unique to China's silver standard. The question is whether this pattern repeats. British India from 1873 to 1893. That's 20 years. One currency standard under pressure from the same force that squeezed China. The global shift toward gold backing. Germany abandoned silver in 1873. The United States followed the gold standard in 1879. India operated on silver rupees. The metal that had been money for centuries was becoming inventory. Wave 1. British merchants in Bombay watched the price decline accelerate during 1874, 1875, and 1876. They converted rupees to gold-backed sterling before the wholesale rupee collapse became obvious. These men read London price telegrams daily. They understood the signal before any government issued guidance. Wave 2. Coastal Indian merchants followed. The evidence was physical, not abstract. Wholesale prices for imported goods kept rising. A rupee bought less each month. By 1877, they understood. The currency was liquidating itself, the same as Shanghai's would 47 years later. They converted between 1877 and 1882, slower than Wave 1, but still before official policy changed. Wave 3. Interior agricultural savers. The ones holding rupee coins in villages across Bengal, Uttar Pradesh, and Rajasthan converted only in 1893 when the government formally abandoned the silver rupee standard. By then, their purchasing power had declined 47%. They received government-mandated conversion rates for money that no longer functioned as currency reserves. Same mechanism, opposite price movement. Same three-wave cascade, emptying the trap through different information speeds. The structure isn't unique to China. It activates whenever face value diverges from commodity value for an extended period. Whenever the thing that is officially money becomes simultaneously tradable inventory with a separate market price somewhere else. This pattern doesn't need silver or any specific commodity. It repeats wherever official exchange rates differ from market exchange rates long enough for different groups to recognize the divergence at different speeds. The information cascade executes the same transfer. The wealth doesn't vanish, it reallocates. From the people who wait for official confirmation to the people who watch what actually moves. October 1935. The announcement came: fiat currency reform. Silver dollars would convert to paper yuan at official rates. The chest of coins Chen Wei kept in the back room, his father's inheritance, $2,400 in stacked metal, was now illegal to hold. He would surrender it for paper. The $6,000 in his Bank of China account would become 6,000 paper yuan, locked at the government exchange rate. The merchant who shared Chen Wei's warehouse received the same announcement. His money had left China 13 months earlier. November 1934. Converted to Hong Kong pounds when shipping manifests showed silver leaving faster than deposits grew. 12,000 silver dollars. The pounds were now worth $15,800 equivalents. Same warehouse, same newspapers, same access to vault observations and shipping manifests. Chen Wei had seen the empty shelves in March 1934. The merchant had seen them too. Chen Wei accepted transferred for rebalancing. The merchant asked what rebalancing meant when outflows exceeded inflows. One question. 13 months of difference. The textile business survived. Chen Wei still had his client contracts, his warehouse lease, his accounting ledgers. What he didn't have? 3 years of retained earnings, his father's inheritance. The cushion that separates a business owner from a man who cannot afford a single bad season. The merchant had the same cushion he'd built, larger because he'd captured the arbitrage that Chen Wei had funded. The Bank of China vault in Hong Kong, the one that had been rebalanced, was full, not of silver, of foreign exchange that used to be deposited by men like Chen Wei, who trusted that following institutional guidance meant following the safest path. The institution preserved its reserves. The depositor preserved his business. The difference between survival and preservation was recognizing that when an institution says rebalancing, you watch where the metal actually goes. The forensic record shows the opposite of what official histories claim. Official institutions executed Wave 1. February 1934. Banks didn't protect depositors. They moved first, recognized the arbitrage before the Silver Purchase Act even passed, converted their own positions while telling customers the system remains stable. The vault transfers weren't operational rebalancing, they were tactical repositioning. The law accelerated the liquidation. Every capital control opened 3 workarounds. Ban silver export, melt it first. Commodity silver remains legal. Require exit permits over $500? Use Hong Kong intermediaries. Mandate bank reporting on conversions? Route through textile merchants who need yuan for imports. The government responded. The mechanism adapted faster. Official guidance came 20 months late. February 1934. Silver leaves Shanghai. October 1935. The government announces what already happened. By the time Chen Wei received institutional confirmation that action was necessary, the transfer was complete. Announcements acknowledged finished operations. They didn't trigger them. What preserved wealth wasn't legal compliance or institutional trust. It was watching what moved, not what newspapers printed, not what bank clerks explained. What actually left the docks, the shipping manifests, the vault shelves, the physical evidence that silver was traveling one direction, while official statements traveled another. This mechanism still operates. Anytime money contains a tradable component that develops a separate market price, it becomes vulnerable. Commodity backing, foreign exchange reserves, sovereign debt holdings. When face value diverges from market value for long enough, the same three-wave information cascade executes. Wave 1 moves on policy signals before implementation. Wave 2 moves on physical evidence, shipping volumes, reserve disclosures, clearing data. Wave 3 moves on official announcements after the arbitrage window closes. Commodity money self-liquidates when commodity value exceeds face value. Fiat money self-liquidates when market exchange rates diverge from official rates. The structure repeats because the vulnerability is structural. Embedded in any monetary system where the material, the backing, or the reserves trade separately from the currency itself. The people who survived China 1934–35 didn't predict the future. They recognized the present faster. They saw February's signal. They didn't wait for October's confirmation. Subscribe if this forensic breakdown gave you a new lens on how wealth transfers during currency transitions. The next video documents 1948–49. The people who converted the paper yuan in 1935, thinking they'd escape the silver trap. Same information cascade, different asset, same three waves. You'll want to see what Wave 1 positioned for before the second collapse reached them.